Welcome to Custom Home Builder Solutions, a web-based software also known as CHS, a standalone accounting suite focused on job costing and profit management for professional home builders. Hello everybody, my name is Carol King and I am the developer of Custom Home Builder Solutions, also known as CHS. In this video I would like to introduce you to a new nifty tool that we have that is available for free on our website to use as long as you'd like, whether or not you subscribe to CHS. The tool will help you decide what markup percent you should be using, the difference between a markup percent and a margin percent, and exactly what gross profit means. So let's get started and click the link here and to open the tool out on the web. This is simply a markup, margin, net income, and cash flow calculator. This means that data that you enter here will not be saved. It's just simply to calculate some things, and you can print a report of all of this when you're done to see what you entered. This is to figure out what markup percent you should be using to mark up your job costs in order to make sure that your gross profit will cover all other cash out expenses of your business, including how much you, the owner, want to take out for your own lifestyle. And if you are a subscriber to CHS, there will, of course, be all sorts of fantastic financial tools to review your past year's data and averages to come up with amounts to enter into this calculator. Let's take a second to look at the rules on this calculator. First of all, up here at the top you'll see that it says fill in blue ones. That means these things that show up in blue. If they are in black, CHS is calculating those amounts. So you'll see various things on this screen where you can enter how much is your salaries or other expenses or a payroll burden, etc. We'll get to that, but they're all in blue, and this is where you would put how much you as the owner have left to take out of the company. So we covered that real quickly, that it's everything in blue. The other thing, it says if there's a plus sign, see how there's a plus sign down here and a minus sign down here. If there's a plus sign, enter a positive amount. If a minus sign, enter a negative amount. Notice this minus sign here. If I just type in 2,000 as a positive number, you can see this thing coming up that says, oops, other cost of goods sold must be less than or equal to 0. So you right away can see that there's been a boo-boo. So if you change it to a negative amount like it should be, that notice will go away. Let's go ahead and set that back to 0, and hopefully you get the idea of the rules for this calculator. Before I go any farther, I'd like to give a quick shout out to Sean Van Dyke, who wrote the book Profit First for Contractors. You can find videos by him and consulting by him, and I think you will be totally impressed by him. He has a lot of good advice for builders. And he said, I learned the difference between markup and margin and used these two numbers to guide every decision in my construction business. That fact alone created the profit I needed to sustain my construction business. And I realized while I was reading the book that I could make a tool that would help you just play with this kind of concept and make it free on my website. And of course, that's the tool that we are reviewing right now, and I may use some phrases from Sean as I talk, and he might recognize those. As I've said, I will use this tool to explain what both markup percent and margin percent mean, and the difference between those two. We will also go over what gross profit means. The very first thing that you will put into this calculator would be your job costs. And I'd like to use Sean's words to explain what job costs are. They are also referred to as job costs of goods sold, and you'll see as soon as I put an amount in here, it will be supplied as a negative amount down here. Per Sean, Costs for a construction business are also referred to as cost of goods sold, like I said. They are typically the cost of labor, material, subcontractors, and equipment. These are things that you buy, mark up, and sell to your customers. And if it's not a cost of goods sold, then it's an expense, and we will get to that in just a little bit. You can see here that there are little question mark buttons that you can click on for more information about what you're about to do in a field near it. For example, here's the one for job costs, and here's the stuff that I just told you about, various things with some additional, and what kind of number you might be wanting to put in that field. So we're going to start with just this top part and just focus on it before we get to the rest of the things that determine whether or not your gross profit is high enough to cover the other expenses of your construction business and what you'd like to take out. So for job costs, in CHS, at CHS, we have builders that build dozens of homes a year, or one home a year, or two homes a year, etc. But to keep it simple, let's just start and play like in this year. We think we'll only build one house that costs $400,000. Many custom homes cost much more than this, but we're using it for an example. Now notice that when I typed in the job cost, that's what I think the exact direct costs are, that minus $400,000 got put down here in something called job costs of goods sold. And as I've said, job costs are referred to costs of goods sold to help figure out what your gross profit is. Right now, we don't have any gross profit because we have not entered a markup percent here. And before we enter one, I'd like to show you that if you click this link up here, we give you some information about what the difference is between a markup and a margin percent. And it's easy to be confused by those because markup and margin sound kind of alike, all these various terms. But I like to use a simple candy bar example. If you plan to buy from the manufacturer a candy bar for 80 cents, and then you plan to resell it for $1, the markup amount is 20 cents, dollar minus 80 cents. And that is actually 25% of your cost, or the 80 cents. The markup percent then is 25%. That's how much you would figure out 25% of 80 cents is 20 cents, and you add that to 80 cents to get your dollar. The gross profit amount is also 20 cents, but it is 20% of a dollar. When you talk about a gross profit amount, you'll take the total revenues you expect, or the sales price of $1, minus the costs to come up with your 20 cents, just like you did here, but you divide it by the sales price. And that's what your gross profit percent is, or your gross margin percent, or your profit margin percent. You'll hear it said all kinds of ways. That's what causes that to be 20%. So a markup percent is always higher than the gross margin percent because they're divided into different things. The markup amount and the gross profit amount are the same amount, that 20 cents, but that amount is a larger percent of the cost than it is of the price. The percent of the cost is your markup percent, and its percent of the price is your gross margin percent. And when you bring this up, these are active links. This is a really great little video that's a whiteboard video about markup versus margin that really spells it out. It's a really good one on the Journal of Light Construction site. And then here I'm mentioning Sean Van Dyke again, and a video that he has where he really does get into the markup versus margin and gives you a chart of various markup percents and then what the gross margin would be for each one of those. So you could click on those and go watch those videos. So let's pretend that you didn't just hear what I said or didn't understand it or whatever, and you think, I always hear that I should have a profit margin percent of 20%, and you're not really understanding the difference between markup and margin. So you just are tempted to put, when you see markup percent, you're tempted to put in 20%. So let's do that. What I'd like you to see is how CHS immediately figured out what the margin percent is, and that yes, it is lower than 20%. It is not the same thing like I just explained. Also, once you put in the job cost and the markup percent, CHS figures out what the job revenues are, also sometimes referred to as sales, sometimes referred to as gross income. There's always all these various terms. Basically, CHS figured out that 20% of $400,000 job costs was $80,000 and added the $80,000 to the $400,000 to come up with the $480,000 sales price. Now let's decide that we really do want that margin of 20%. So let's change this markup to 25%. You can see that here now we're going to make 100,000 or 25% of 400 or 20% of 500,000, the sales price. So when I said you were going to make $100,000, I didn't mean that that's what your net income was going to be for after the various costs of running your business in other places. So we're now going to scooch on down this calculator for a minute, and we're going to look at another place we have for some additional gross profit. You can enter things here, or if you're not going to have any other income besides what you do for jobs, you can just leave these at 0. But let's pretend you might be getting consulting income or various things, but we're going to pretend like maybe we have a rental property where you get $1,000 a month of gross revenues from that. So that'd be $12,000 here. We enter it as a positive amount. And then this other cost of goods sold would be various direct costs that have to do with the revenues, the other revenues that we're receiving. So if you were doing consulting and you had to travel, maybe that's a direct construction cost. I mean, not construction, I'm so used to saying that. Maybe that's a cost of goods sold for these other revenues. But for rental properties, let's just say we sort of average, maybe it's more, but we'll say $2,000 a year. Now notice that we've added $10,000 to gross profit for the entire company. Up here we say jobs gross profit, so that you can just play with your markup percent and see how that changes. And then down here we might add in a little bit more gross profit that the company is making. So now we're making $110,000. So let's move on down and talk about operating expenses. First of all, there's a commissions place right here. Some builders hire sales agents to sell their homes, and perhaps they figure they're going to be paying out 6% in sales commissions. So up here at the top, that's what that field is for. So let's just put 6% in and see what happens down here. Now we're saying we're going to be paying $30,000 out for commissions on these various things. And I'd like to click this question mark button for just a second. Per the accountingcoach.com, commissions are compensation for obtaining sales. Hence, sales commissions are a selling expense and will be recorded in general ledger accounts. That's your accounting chart of accounts, having sales commissions expenses in their title. Sales commissions are considered to be operating expenses and are presented on your income statement as SG&A, which is an acronym for Selling, General, and Administrative Expenses. Sales commissions are not part of the cost of a product. Therefore, sales commissions are not assigned to the cost of goods held in inventory or the cost of goods sold for the jobs. So I wanted to tell you why we have the commissions down here and not up there as part of the direct job costs. So it calculated 6% of 500,000 and put minus 30,000 in for you because of your 6% up at the top. Now, if you pay various salaries, let's just for some reason say we're paying a bookkeeper right now, you know, $60,000 a year or less. I'm not sure, but let's just say that. And then we have something called a payroll burden percent, because you know when you have salaries, you're paying, you're matching, the employer is matching the Social Security and Medicare that the employee paid out of their check, and the employer matches it, plus maybe some workers' comp things, health insurance, other things. I've commonly seen a burden for the employer being maybe 11% of salaries. So that's what I typed in here, or what I have defaulting in here. There's a question mark button that explains more about payroll burden. But you need to add, not just do the $60,000, but maybe add in some burden for the additional stuff that you'll be paying for that employee. You might talk that over with your accountant. Now the other expenses is for you to just sort of go out, average what other things like accounting services, insurance, interest, office rent, office supplies, telephones, tools and utilities, depreciation and more, and just sort of average what those things without the salaries are costing you each year, or what you hope they cost. So let's just decide, who knows, maybe we figure out we're spending a couple thousand or so per month for this. So let's just say minus 24,000. And notice what happened as soon as I did that. Our 110,000 minus these various things means that we are doing a net loss right now based on this kind of expenses that we have to run our business. So what you might do is stop right here and say, well, to have this kind of thing, let's just change it right now for a second to 40,000, so that we do have a little bit of net income over here. Now what I'd like to show you is, probably with that low of a net income, I'd like you to talk with your tax preparer or CPA and get some sort of income tax rate that you might be paying. Now I know a lot of calculators show things without the income taxes, but we are actually coming over here now to see what kind of cash flow we will have even after paying taxes. So whatever your CPA or tax preparer might say your income tax percent is, let's say they told you 28%, but probably in this case with this low of a net income, you won't be much higher than 15%. So let's just put that amount in. Now let's see what the taxes were just based on that. And we don't have any other cash coming in. This could be cash you're thinking you're going to get from an investor that is not part of your income statement, or a loan that you might be getting, but I'm just going to leave that alone right now. But let's say in your head that you thought, I need to take as an owner draw. Other cash out can be owner draws or payments on principal on loans, etc. But let's say you don't give yourself, you don't do it like as a salary, but you're wanting to do owner draws because you're a sole proprietor, and you know that for your own lifestyle you need $75,000. Now right away we can see that we have a negative cash flow. We don't have enough money in this scenario to be doing that. So let's see what happens. This is what this tool is all about. What if we just change our markup to 30%? Well, that doesn't help. We're still 49,160 down. So you might decide, well, what happens if I do 50% markup? You know, because I just want to build one house a year. Well, that might be a hard sell to your customer to do a 50% markup, but maybe you can if you're a good salesperson. So you say, I'm going to have 50% because 45% gets me in the negative of my cash flow. Doesn't let me have enough. So I'm for sure going to need a 50% markup for selling just one home. The other thing you might decide to do is say, well, we need to maybe build a couple of houses that cost $400,000, so we'll change to $800,000. And we'll go back to our 25%. Well, that 25% is still not quite covering it, especially because your net income is now $81,000. So it's possible your income tax rate might be maybe 28%. So you're still short right here to get your $75,000 out of this. The other thing is you might have needed to increase your salaries, but we won't go do that. So you say, well, what happens if I do 30%? There you are. You have $75,000 left to take out, and you have $10,000 something left in your bank to cover some expenses maybe you didn't think about or to hold on to for the future. So you can see how you can play with this in this scenario with just $40,000 in salaries to somebody, and you apparently not having any superintendent or project manager actually, because you definitely need to have a good bookkeeper, and probably one that costs a little more than this if you really want to successfully run your business. But you'll hear me talk about that later. So hopefully you get a concept of how your putting these other things in and deciding, well, I'm going to have to put a 30% markup in, because again, the 25% for the 20% gross margin is not going to cut it and give me what I want to take home for my lifestyle. Enjoy the tool, just play around with it, put in all kinds of numbers however you like, and talk to your tax preparer, because I do like to include the cash outflow for income taxes. But just remember, if you're doing, forecasting a net income as higher and higher, you might need to go up in this percent you might be paying out for income taxes. Now I know there's standard deductions in this and that, so this really might not be 28% of the net income, but it kind of gives you a cushion anyway. If you get your taxes a little too high here, that's kind of a good thing. It's like you're being conservative and going ahead and planning for them to be higher, and then when they're not, that'll be a great thing. So our final conclusion on this scenario is we're going to have to do 30% markup if we're just going to build 2 houses for $400,000. And that all depends on the expenses you have to sustain your construction business. Before I leave this video, because I've mentioned Sean's book, Profit First for Contractors, I want to do a little plug for CHS here. Whether this relates to his concept of moving profit out to another profit account in order to cover your overhead or not, I'm not totally sure, but I'm thinking this could help. In this case, I wanted to show you a report that CHS can make for you for one job that is called a profit transfer worksheet. And what it is doing is bringing in all sorts of numbers and figuring out, say when you get a draw, how much you might want to go ahead and take and move on out of your construction checking account for the profit that you earned. You'll need to read his book to sort of start talking about having a profit account that you're moving money to. I believe his is you figure out an overall percent that you should take out of all the money that you receive for your entire company. In this case, I'm just talking about one job, and you can pull these up for each of your active jobs. If you watch our introduction video about CHS, you will see how smart CHS is about deciding what contract type a particular job is, and how smart it is about figuring out what your current revised price is. That price can be changing based on change orders that you've issued, or if it's a cost plus job like this one, based on what your current estimated costs at completion are today, which CHS is actively figuring out based on whether you've entered purchase orders that are over or under your original estimate, or actual costs that you've actually typed in a different amount on the estimated cost at completion worksheet. Please watch our introduction video for a little more information. But I'd like you to know that CHS is coming up with a revised price based on your activity. It's doing that for you, or minus the estimated cost at completion, is what you're estimating your profit to be today. Now, it's real important that you don't decide you're going to do a transfer out of your construction if you don't have enough money. So you would have needed to receive the money before you're doing this kind of thing. But what it's doing is figuring out the costs that you've posted to your accounting, actual job costs that you've posted, paid or unpaid really, to your accounting. It comes up with a total there to figure out how much percent complete you are on the job, and that's this amount divided by the estimated cost at completion. Then it figures out from that, using this percent and taking it times the revised price to figure out how much you've really earned to date on this job. Then it shows previous profit transfers because it's tracking them. It knows what you already took out for profit based on the system that is described below. And so it takes the profit earned to date minus what you've previously transferred and says earned profit to transfer. In our concept in CHS, a lot of times people have a construction checking and an operating checking, and they are moving this amount out of the construction account into the operating account to cover those operating expenses. But you do have to have enough cash to do this, so CHS is also very smart about tracking how much cash the job has in. So it'll show the revenues received minus the posted cost to date that you might either have paid already or you're about to pay, less the previous transfers to say this is how much cash you have available for this job. Here's that earned profit to transfer. So there is enough money for this job in the construction checking to go ahead and transfer out this. Then it does the remaining estimated cost to show how much is over or short all the way to completion. Does the revised price again minus the revenues received to show you how much revenues you're expecting out to the end of the job. Over short for completion, which is this number up here. Additional profit expected. So this is how much more money you might be expecting in as profit that you would be able to take out of this job. And then previous profit transfers, and then this earned profit to transfer ends up being the estimated profit at completion, which ties right into this number right up here. I don't want to get into this anymore. I just wanted to point out how active CHS is about figuring out all kinds of things that might slightly relate or help with the concept that Sean is presenting to you in his book. Thank you for watching this video.